The biggest financial resurrection in history started with crushing debt. At the end of his life, Michael Jackson owed an estimated $500 million. His personal balance sheet was completely toxic. It was fueled by an unsustainable lifestyle burn rate, collateralizing future royalties just to keep the lights on. Yet today, his estate is a $2 billion corporate fortress. How did Jackson achieve this ultimate pivot from insolvency to institutional wealth without recording a single new product? Jackson built his initial fortune on a biological model. He relied on global touring and physical record sales. That wealth engine required constant physical exertion and massive stadium logistics. When that stopped, the active income permanently collapsed. But a profound structural shift occurred. The hidden reality is that the end of his life permanently and violently halted the irrational capital leakage driven by human emotion. The endless spending on private infrastructure simply vanished. The legal executors did not panic. Instead of fire-selling the catalog to appease creditors, they restructured the initial debt. They secured fresh institutional loans against future royalties, buying time. They allowed his master recordings and publishing rights to compound in value, treating them as digital real estate. This patience set up a monumental capital liquidation event. The estate executed a transaction that valued the underlying intellectual property at an astonishing baseline of $1.2 billion. They pulled this off by liquidating exactly 50% of that asset for a reported minimum of $600 million in pure, unencumbered cash. They instantly cleared all historical liabilities, but crucially, they retained the remaining 50%, ensuring they capture the infinite upside of future algorithmic streaming. But this aggressive restructuring comes with a catch. What happens when managing a global cultural legacy becomes so lucrative that the corporate lawyers capture more structural wealth than the surviving family members? Total operational control was stripped from the grieving family. The assets were locked into an irrevocable trust, a binding legal structure that prevents outside interference. The entire portfolio was handed over to two professional co-executors. This legal partition severed volatile family dynamics from clinical capital allocation. The fiduciaries began executing massive commercial transactions with the speed of a private equity firm. When a lucrative commercial opportunity arises, they do not wait for a family consensus. They simply execute the deal. But this ruthless competence is incredibly expensive. The managers extract a heavy toll from the top line. Based on standard industry models, an immediate $7,350,000 is stripped from the gross revenue purely to compensate the apex fiduciaries for their capital allocation strategies. They are paid a calculated percentage of the gross enterprise revenue. They collect millions before the remaining funds ever reach the beneficiaries. This dynamic creates a deeply polarizing question. Should professional trust managers command a massive percentage of all gross revenue generated by a cultural legacy they did not originally create? The family lost a fraction of their inheritance to external managers, but those managers saved the entire empire from the government. The sovereign tax authority moved aggressively to extract wealth from the estate. When a wealthy individual passes away, the standard reality dictates a massive tax assessment. The government authority aggressively assessed the image and likeness at over $161,307,045. They demanded hundreds of millions in immediate taxes and understatement penalties. Instead of accepting a distressed liquidation to pay the bill, the legal team initiated a decade-long litigation war. They deployed a highly counterintuitive defense. They weaponized the toxic public relations disasters of Jackson's final years against the government. The lawyers argued that his brand was so deeply compromised by relentless scandals that the actual market value of his likeness was statistically negligible. They used brand toxicity as a defensive shield. It was a brilliant, emotionally detached strategy. The court crushed the likeness valuation down to a final ruling of just $4,153,912, saving the enterprise an estimated $166 million. The corporate fortress is fundamentally sound against government extraction. It is completely immune to external market forces, but it is deeply fragile on the inside. There is a permanent misalignment of incentives, a principal-agent conflict, at the very heart of this trust. The fiduciaries are compensated based on massive transactional volume. They earn premium administrative bonuses for orchestrating high-stakes catalog sales and complex licensing deals. The heirs, however, desire legacy preservation and complete financial transparency. This clash creates continuous warfare in the probate courts. The beneficiaries attempt to block transactions and audit the massive administrative fees. The trust structure is generating severe internal legal friction, including over $115,355 in direct attorney costs levied against an heir following a failed anti-SLAPP motion. This is a legal maneuver used to dismiss lawsuits quickly. The lawyers make the challenge process as demoralizing and expensive as possible for the heirs. This reveals the intrinsic vulnerability of the system. The ultimate threat is not that the music will stop streaming, but that the family and fiduciaries will bleed the operational cash flow entirely through retaliatory legal warfare. Despite the internal battles, the financial turnaround is an undisputed masterclass in wealth preservation. The core mechanism of the Lazarus architecture relies on decoupling revenue entirely from human performance. The estate shifted from trying to sell unreleased audio tracks to creating high-margin experiential retail properties. They partnered with global institutional production companies to launch acrobatic residencies and Broadway theatrical shows. These ventures require absolutely zero physical input from Jackson, yet they capture massive consumer retail spending. This creates a highly predictable recurring revenue loop, converting passive history into aggressive cash flow. The final ledger proves the math. Through ruthless legal defense and intellectual property securitization, the estate turned a completely collapsed personal balance sheet into a $2 billion corporate fortress, generating over $105 million annually to dominate the sector. They transformed a bankrupt ecosystem into a hyper-liquid holding company. They achieved this by removing human emotion, locking the assets behind a legal wall, and letting cold corporate logic administer the rights. To the members of the Capital Logic Network who support our channel and make this possible, thank you for everything.